bear put spread, an option strategy to try in declining markets. So in options trading, a bear put spread is also known as debit put spread or a long put spread. The bear in the strategy's name refers to bearish sentiment, betting on the downside of the market. So put spread means buying and selling put options with different strike prices but the same expiration date. Typically, a bear put spread is used when a trader is expecting the price of an asset to decline. To set up a bear put spread, the trader buys a put option while selling a further out of the money put option of the same size with the same expiration date. This allows a trader to reduce the overall cost involved. More in this section below. There's a diagram showing the put option. So here's how the bear put spread is set up. So you buy an at the money put and you sell an out of the money put with the same size and at the same expiry. A bear put spread is designed to help traders profit from assets moving down. It is cheaper than only buying a put option. So the options strategy comparison, we are basically comparing a bear put spread versus a bear call spread. So a bear put spread is to bet on prices of the underlying security going down. Or what if you are unsure and you prefer to bet on prices not going up? You can consider doing a bear call spread, aka short call spread. A bear call spread is a neutral to mildly bearish strategy that involves selling a call option while simultaneously buying a call option of a higher strike price on the same underlying asset with the same size and expiry date. This way, even if the price goes sideways, you receive profits, which is the difference between the premium you receive for selling a call option and the premium you paid for buying the call option further out. Maximum loss, the difference between strike prices of calls, that is strike price of long call less strike price of short call, minus net premium. It occurs when the option expires about the strike of the call options. So maximum profit is equals to net premium or credit received. So bear put spread versus the bull put spread. So a bull put spread strategy is a neutral to mildly bullish strategy that involves selling a put option while simultaneously buying a put option of a lower strike price on the same underlying asset with the same size and expiration date. This way, even if the price goes sideways, you receive profits, which is the difference between the premium you receive for selling a put option and the premium you paid for buying the put option further out. And you receive the maximum gain if the option expires worthless. Maximum loss, the difference between strike prices of calls, that is strike price of long call less strike price of short call minus net premium. So it occurs when the option expires below the strike of the put option. Maximum profit, so net premium or credit received. So who can use a bear put spread? So contrary to a long put option, the bear put spread reduces the maximum loss that may be incurred, making it potentially less risky for traders. However, it also limits the maximum amount of profit that can be earned. So to maximize gains from their trades, a trader will need significant technical knowledge to know which strike prices to sell the put options at. Therefore, this strategy is best suited for intermediate and advanced traders. When to use the bear put spread? As its name suggests, A bear put spread is used when a trader believes that the price of an asset will be bearish to mildly bearish. So the ideal scenario is when a trader believes that the price of the asset is going to go down in the near term, but won't go below a certain key support level, which can be ascertained from strong moving average support or Fibonacci levels. In terms of choosing the expiration date or date to expiry, we recommend that you choose a date 30 days longer than you expect the trade to be in the trade due to theta decay. So for example, if you think the price of Bitcoin will drop within 15 days or that you'll be in the trade for 15 days, it's best to select a date to expire close to 15 plus 30 days, which was 45 days. So bear put spread options. So step 1, you visit the official Bybit website and select USDC options on the derivatives. And step 2, you pick the desired expiration date or show all the expiration dates at once and then pick one. So you look at the expiration dates and then pick one. So step 3, choose the strike of the put option you want to buy, in this case at the money, as well as the strike of the put option you want to sell, in this case out of the money. Okay. So step 4, review the details of the options and select the ones you want to buy and sell, either by price or action. Okay. So select step 5, select place order for each buy and sell order to review a confirmation tab. Okay. Step 6, ensure that the information entered is correct and click on confirm. So after you check, you then click on confirm. So now that you know how to set up a bear put spread, let's explore a few hypothetical scenarios. So break-even point: if the price of Bitcoin closes at $18,500 upon expiry, the trader will break even as $20,000 long put strike minus $18,500, which is the current price at expiry, minus $1,500, which is net premium paid, is equals 0. So break-even point, long put strike price minus net premium paid is equals to break-even point. Bear put spread sweet spot: so if the price of Bitcoin closes at the sell put strike price, this is the sweet spot. The sweet spot profit is long put strike price minus short put strike price minus net premium paid. So adjustments to make in bearish markets: so if you enter this bear put spread trade believing that the asset price will go down but it goes up instead, you start losing money. Here are two ways you can repair the trade. To sell additional puts: so if you believe that the price will stay above your long put and the price won't go below your short put price for the duration of the trade, then you can sell additional puts to cover the net premium pay. So let's assume your Bitcoin bear put spread costs $1,500. Because Bitcoin went up, selling the Bitcoin put option at a $16,000 strike now gives you $500, and you can sell an additional trade put contracts at $16,000 to cover the cost. This turns your bear put spread into a spread that's almost akin to a ratio put spread. This strategy is highly risky as your maximum loss is infinite, and you risk getting liquidated if the price continues falling towards $16,000 and below. So sell a call option or bull call spread. So another strategy when the price starts to go up is simply to sell a call option or bear bull call spread. If you believe that Bitcoin's price won't go above 22,000, you can sell a 22,000 call option for $600. Selling 2.5 of these options will cover the premium cost of your bear put spread. However, this move is considered naked selling and comes with high risk. The maximum loss will be infinite if Bitcoin's price were to increase infinitely. To reduce your risk, you can consider buying further out of the money call options to hedge, essentially selling a bull call spread. However, doing this means you need to sell more call options if you want to break even on your bear put spread. So maximum take profit potential. So the maximum take profit potential is unlocked when the price of an asset drops rapidly toward the short put strike price. Immediately after a trader sets up bear put spread, the price drop increases the value of the put option, while having it happen immediately means that the time value remains high. It's recommended that the trader takes some or all profits to capitalize on the gains on the bear put spread if the time value or theta is still high. With each passing day, the setup loses money due to theta decay, also known as time premium. One important thing to note here is that this time value decay happens more rapidly in the last 30 days of a contract. Therefore, a contract should be correct on the direction of the trade, but the option trade will still lose too much time value. In this case, the trader will end up with a loss. Therefore, it's always recommended that you have both a mental take profit and stop loss percentage amount before entering the trade. So maximum profit potential: long put strike price minus short put strike price. Maximum profit at expiration equals long put strike price minus short put strike price minus net premium paid. So maximum incurred loss potential. So the formula for your potential maximum loss is simply the net premium paid. The maximum loss equals cost of buying put minus earnings of selling put, which is equals to the net premium paid. To bear put spread example, here you can see that someone basically took a short when the moving away the red one crossed the blue one above here and held the position all the way to where the price is at currently. So example, let's presume that Bitcoin is trading for around 20,000. If a trader thinks that Bitcoin is going to decline further in price within 20 days, the trader can set up a bear put spread by purchasing a put option contract with a strike price of 20,000 expiring in around 50 days for a cost of $22,100. Let's say that the trader also thinks that Bitcoin won't drop below $16,000. So in the worst case scenario, the 300-week moving average Bitcoin has in place will be triggered. This acted as support during the COVID-19 market crash in March 2020. As such, the trader is willing to sell the put option with a strike of $16,000 and earn $600 in order to subsidize the cost of buying the put option. This results in a bear put spread. In this case, the trader would need to pay $2,500 to set up this strategy. Pay $2,100 minus $600 instead of spending $2,100 if the trader only bought put options. So in summary, here's what you've done: buy and add the money put option expiring 50 days later. Sell and out of the money put option around 16,000, the same size and same expiration date. So now let's explore a few possible resulting scenarios. So maximum loss scenario: if the price of the Bitcoin closes above 20,000 upon expiration, the trader will lose a net premium paid of $1,500. So profitable scenario: if the Bitcoin lands between $18,500 and $16,000, such as $17,500 upon expiration, the trader will earn a profit of $20,000. So it's long put strike minus $17,500 as current price at expiration minus $1,500 is net premium paid is equals to $1,000. So sweet spot or max profit as expiration scenario: so if Bitcoin drops to $16,000 on expiration, the trader will earn a profit of $20,000. In bracket, the long put strike minus $16,000, which is a short put strike minus $1,500 is the net premium paid, which equals $2,500 as profit. So bear put spread tips. So here are 2 tips to help you maximize profit from the bear put spread strategy. So buy an options expiration date that's 30 more days than you expect to be in the trade. So in order to mitigate the loss of value from rapidly increasing time value decay in the last 30 days of your setup. So sell your put option at a strike price where there is strong support to maximize the profit you receive. So determining how much capital you can allocate to trading options can be challenging. The rule of thumb for options traders is never to use more than 2% of your trading capital to purchase an option. Example, if your trading capital is $20,000, you shouldn't use more than $400. So margin requirements. All margin requirements for options in US are regulated by Federal Reserve Board Regulation T, also known as Reg T. For a bear put spread, as long as both positions are maintained, no margin money is required. So theta decay impact. The theta refers to how much time decay affects the total value of a position. For every asset, the total value reduces in relation to the proximity of the expiration date. That is, the closer a position gets to its expiration date, the lower its values become. Time decay or theta works against bear put spread. This means a bear put spread has a negative theta that loses money with time decay. Implied volatility effect. In terms of the volatility of the IV spike, it won't have a huge impact on the bear put spread strategy, as the two mostly offset each other. However, this is not the case if you are selling a bull put spread. So benefits. 1. The benefit of a bear put spread is that the trader reduces the cost of the trade. If the trader doesn't expect the price of the asset to drop much below the put option that was sold, this strategy is better than simply buying a put option. 2. A second advantage is that the break-even price also rises. As a result of setting up a bear put spread instead of only buying a put option, the trader reduces the dollar risk if the trade goes against them, and also increases their probability of profit. So 3. Additionally, unlike other advanced strategies such as a butterfly spread strategy, the downside risk of the bear put spread is capped. So the risks are: 1. The downside of a bear put spread is that there is limited profit potential as compared to buying a put option. The potential is limited to the difference between the two strikes minus the premium paid. So 2. If a trader is expecting a black swan or a capitulation event, it's preferable to simply buy a put option as prices may fall far below any support levels. Alternative strategy. So one alternative to the bear put spread is the ratio put spread, sometimes referred to as put back spread. The ratio put spread is similar to the bear put spread, but instead of selling one put option, you sell 2 or even 3 put options at the same expiration date to cover the cost of your ATM put option. However, this strategy is very risky and more suited to expert traders. So to conclude, if what you seek as a trader is to profit from markets going down by a certain amount, the bear put spread strategy could be your best bet. Compared to buying put options, it offers a better probability of profit and reduces your maximum drawdown if you make a wrong decision. A bear put spread is also a great alternative to outright shorting, as it requires less capital to execute.